Okay, so in today's class, we will be discussing this September-December 2021 exam. Question number 2. We have already discussed the ZG company question number 1. Now there are 2 questions in section B, so we will be firstly doing section B question number 2. The name of this question is Hanwood shoes. I will be reading the requirements and then going towards it. Okay. Okay, the following exhibits available on the left-hand side of the screen provide information relevant to the question: Hanwood shoes, sale of children's shoes, impact and consequences of sale, Hanwood shoes, statement of financial position. Information should be used to answer the question requirements within your chosen response. It's just like the ZG company question which you did, that exhibits are given. We first read the information from the exhibits and then move forward. I will read the requirements later. First, I will go towards the exhibits, that what exactly is the information in the question, basically. You can also download this question from accaglobal.com. Okay. So let's start the question. Exhibit 1. Hanwood shoes started trading 40 years ago. Okay, so Hanwood shoes started trading 40 years ago. Manufacturing and selling children's shoes in shops. So they are manufacturing and selling children's shoes. The shoes have been of a higher quality than shoes produced by its competitors, although more expensive. School shoe sales in particular have been consistent large generator of cash, helping to fund the company's expansion. So Hanwood shoes started trading 40 years ago, manufacturing and selling children's shoes in shops. They manufactured children's schools. Shoes have been of a higher quality by competitors, although more expensive. School shoe sales in particular have been a consistent large in the cash. So when you are making children's shoes, the school shoes are generating more cash. About 15 years ago, Hanwood shoes started manufacturing and selling adult shoes. Okay, so from children's shoes, they moved to adult shoes. Hanwood shoes, adult shoes are currently sold at a higher profit margin than children's shoes. Adult shoes have a higher profit margin. Adult shoe sales now generate the majority of Hanwood shoe company's profit. So now adult shoe sales are generating more profit. Adult shoes sold are a mixture of formal types with long lifespan and some fashionable shoes. The inventory turnover period of adult shoes is on average significantly higher than for children's shoes. So inventory turnover period, you know what is inventory turnover period? How many times it takes for inventory to sell. So inventory turnover period for adult shoes is higher than children's shoes. Children's shoes sell quickly. These take time. Hanwood shoes is organized on the basis of 2 separate divisions for children and adults. So it has 2 divisions for children and adults. Its shops sell either children's shoes or adult shoes, but not both. So shops are designed either for children or adults, not both. Hanwood shoes also sell adult shoes to other retailers. You also sell adult shoes to other retailers. 5 years ago, Hanwood shoes restructured its cost base. It moved production of children's shoes to new facilities in its home country and outsourced the production of adult shoes to foreign suppliers. So Hanwood has restructured. It moved production of children's shoes to new facilities in its home country. So children's shoes were moved to other facilities and adult shoes were outsourced, foreign suppliers. However, Hanwood Shoes Board now predicts that profits from children's shoes will increase at a slower rate than adult shoes. So board now predicts that profit from children's shoes will increase at a slower rate than adult shoes. It expects that in the next few years, a greater share of children's shoes market will be taken by companies with a lower cost base. So obviously when higher profits are being generated by adult shoes, so the interest is towards adult shoes. Now the board predicts that profit margin will grow at a slower rate for children's shoes. And in the next few years, the greater share of children's shoes market will be taken by companies with lower cost base. Hanwood Shoes Board is aware that it must convince investors that any major strategic changes it makes will result in increase in earnings per share. Investors will also consider a change in earning per share against any change in the business risk profile of the company. So Hanwood's board is aware it must convince investors that any major strategic change it makes will result in increased EPS. So you need to convince investors for any strategic change. Investors will also consider a change in EPS against change in business risk profile. So it was all about history of the company. Moving forward. Exhibit 2 now. Okay. Exhibit 2 is in a much clearer picture on this downloaded website thing. So Hanwood Shoes Board wishes to improve the company's cash position for 2 reasons. First, loan notes of 175 million nominal value are due to be redeemed in just over a year's time. The board is unwilling to seek renewed loan funding because the terms would not be favorable and some investors are concerned about gearing levels. Second, Hanwood Shoes has recently been slow to pay some of the supplier of adult shoes. One major supplier recently delayed delivery of shoes to Hanwood Shoes until it was paid for previous deliveries. So Hanwood Board wishes to improve the company's cash position. Okay. Board is wishing to improve the company's cash position. There are 2 reasons. One, the loan notes of 175 million are due to be redeemed and they are not seeking to renew loan, and some investors are also considered about gearing. Second, you are not paying suppliers on time, so they also have made late deliveries. Hanwood Shoes CEO proposed that the company should in future only sell adult shoes and should sell the children's shoes division. So CEO, the very powerful person, is suggesting that we should only sell adult shoes, should sell the children's shoes division. He believed from industry contracts that at least 3 children clothing manufacturers looking to expand their project range would be interested. So from his contacts, he knows that 3 people would be interested. The finance director suggested that the proceeds from the sale of division could first be used to pay off the loan notes. It would then be used to increase cash out and thus improve liquidity. So once you sell the children's shoes division, you get cash. And from that cash, the finance director suggested you can repay the loan of 175 million and improve liquidity. The remaining proceeds would be invested in adult shoes division to improve earning per share. These are the plans. A non-executive director asked why liquidity need to be improved. He claimed that higher profits could be achieved by investing funds not required to repay the loan notes in non-current assets. He thought that Hanwood Shoes should maintain the same level of current assets as it is now. NED is saying why you need to improve liquidity. He says that higher profits could be achieved if you invest funds in non-current assets, and you should maintain the same level of current assets. Everybody is giving his views. Exhibit 3. The sale price of the children's shoes. This is exhibit 3. The sale price of the children's shoes division will be the sum of the present value of predicted future free cash flows. Discount rate to be used is 10%. So sale price of children's shoes division, you are willing to sell that division. It will be the sum of present value of future free cash flows. Discount rate is 10%. The predicted after tax free cash flows from the children's shoes division are as follows. In year 1, year 2, year 3, year 4, the predicted after tax free cash flows are given. The predicted after-tax profits of the children's shoes division in year 1 can be assumed to be 76. Total after-tax profits for Hanwood Shoes for year 1, if children's shoe division is not sold, is predicted to be 217. Okay, so after-tax profits of children's shoes division in year 1 is 76 million, and total after-tax profits of Hanwood Shoes, obviously adult, children both, if children division is not sold, will be 217. So out of this total 217, 76 million is from children, and the remaining can be from adults. After year 4, the free cash flows for children's shoes division should be assumed to increase at a rate of 3.5% per year. The proceeds received from selling the children's shoes division would be used to first pay off the 9% loan notes. You will use the receipts to pay off 9% loan notes. Part of the remaining amount from the sale proceeds will be held as part of current assets, so that current ratio increases to 1.4. You will invest them in in current assets, so that current ratio increases to 1.4. Rest of the sale proceeds will be invested in non-current assets. Okay. The profit from the sale of children's shoes division should be taken directly to reserves. The non-current assets of children's shoes division can be assumed to be 608 million and the current assets can be assumed to be 349 million. Additional investment in non-current assets is expected to earn 18% pre-tax return and additional investment in current assets is expected to earn a 6% pre-tax return. Tax is payable at 20%. We'll look at this data again once we are solving the requirement. And lastly, I think there is exhibit 4. Hanwood's SOFP is given. Assets, non-current assets, current assets, total assets, equity liabilities, share capital reserves, equity, non-current liabilities, loan notes, bank loans, total current liabilities, total equity and liabilities. That's it. So in exhibit 1, there was a long talk what Hanwood was doing, children's shoes. It went to adult shoes, 2 divisions, and now adult shoes are generating more profit. So it has restructured cost base, children's shoes to new facilities and outsource adults. And they're expecting in future that other people will take over the children market. Exhibit 2, that we want to improve liquidity because 175 million loan redemption is there. And suppliers are also asking money. CEO is saying that sell children's shoes division and only focus on adult shoes. The proceeds shall be used to pay off the non-current liabilities and the remaining can be used to increase cash. And NED says why you need to do this. Then the data sale price will be from a present value of future free cash flows. The future free cash flows you don't need to calculate, it's given, and other things. And the balance sheet is given. Now I should move towards the requirements. So the first requirement is worth 13 marks. Calculate the expected sale price of the children's shoes division and demonstrate its impact on Hanwood shoes, SOFP, and forecast EPS. So you need to calculate 3 things: expected sale price of the children's shoes division, okay, impact on SOFP, and forecast EPS. 30 marks. So for 13 marks, there are expected sale price of children's shoes division, impact on SOFP, and forecast EPS. Okay, so let's start it. Okay, now I'm calculating the expected sale price of children's shoes division, impact on SOFP, and forecast EPS. Okay, so let's start. I think these requirements are relating to exhibit 3. So I should quickly read exhibit 3 now. Sale price of children's shoes division will be sum of present value of predicted FCF. So I've got my answer. Sale price of children's shoes division, sum of present value of predicted future free cash flows, discount rate 10%, predicted future free cash flows are 4 years given. After tax profits of children's shoes division is 76. Total after tax profit for year 1 if children's shoes division is not sold is 217. After year 4, free cash flows will be growing at 3.5% per year. Perpetuity. Proceeds from selling children's shoes division would be used to first pay off the 9% loan notes. Part of remaining amount of sale proceeds will be held as part of non-current assets. So that current ratio increases to 1.4. Rest of the sale will be invested in non-current assets. Profit on the sale of children's shoes division should be taken directly to reserves. Non-current assets of children's shoes division can be assumed to be 608, current assets 349. Additional investment in non-current assets is expected to earn an 18% pre-tax return. Current assets expect to earn 6% return. Taxes payable 20%. Okay. So I'm doing requirement A now. Okay, so it is asking The question name is Hanwood shoes from September, December 2021. It's asking you three things. Number one, expected sale price of children shoe division. Expected sale price of children shoe division. Now the answer is clearly mentioned, I think. The sale price of children shoes division will be sum of present value of predicted future free cash flows. It's the sum of present values of predicted future free cash flows, 10% discount rate. Predicted future free cash flows are 1, 2, 3, 4, and then 5 to infinity. You know that, okay? The predicted sale price of children's shoes division will be sum of present values of predicted future free cash flows, okay? So predicted after tax FCF. One, 2, 3, and 4, and then 5 to infinity. Actually, I am unable to copy the infinity sign from here, but in the exam tab, you will be given that sign. So you can always mention that sign, okay? The sale price of the children's shoe division, present value of predicted after tax free cash flows. So what are the predicted after tax free cash flows? 76, 81, 85, 88. 76, 81, 85, 88. And after year 4, that means from year 5 to infinity, they will increase at 3.5% per year. Free cash flows. Okay, so increase it by 3.5%. Okay, so these are the predicted free cash flows, and the sale price of children's shoes division is the sum of present values of predicted free cash flows. So it's the sum of present value of predicted free cash flows. So these are the predicted free cash flows. You need present values of predicted after tax FCF. Okay. You need to multiply it with discount factor. If you need present value of after tax FCF, you need to multiply with discount factor. It should be 10%. So 0.893, 0.797, 0.712, 0.636. And remember, for 5 to infinity, I've taught you in the classes, last discount factor, 0.636 upon WACC minus G. So what is WACC? 10%, G 3.5%. Okay, so get that to get present value, B7 into B8. And if we add them all, sum of all present value of predicted FCF. Okay. Okay, some student just messaged me. Some student messaged me that I've used the factors of 12%. I'm sorry for that. 10% is 0.909, 0.826, 0.751, 0.683, and the last discount factor 0.683 on VAT minus G. Okay, so it's 1217 million. This is the present value of predicted after tax FCF. That's the value of sale price of children's shoe division. Okay, if you want, you can please copy. Okay, after this, we got the sale price of the shoe division. We just completed it. Now we need, after this sale price of the shoe division, we need impact on SOFP, right? We need impact on SOFP, statement of financial position. Okay, now if you need impact on SOFP, the statement of financial position, so you have the statement of financial position, right? I would suggest you to copy the same format. The statement of financial position, copy the format so that it will be easy. So assets, non-current, current, total assets. Let me copy the format. Impact on SOFP. Okay. So it's firstly assets, non-current, current. Okay. Then you have equity and liabilities, share capital reserves, total equity. Non-current liabilities have 9% loan notes, 7% loan notes, and bank loan. In the exam, you have an option to copy from the screen. I am not getting that option at the moment. Total non-current liabilities, current liabilities, total equity and liabilities. Okay, so what is the bold? Assets, total assets, equity, and total equity. So 1200, 909 to 109. This is the total assets figure. And share capital 50, 737, 787. Then non-current liabilities have 175, 145, 108. Four two eight 894 2109. So this is the original balance sheet, because I have to mention impact on SFP. So what I did was I made the first original. Now I will make a new one now, because it didn't ask me to make a balance sheet. Just for the sake of understanding, I am making a new one to help you understand how things are going. Okay. Now, if you talk about the requirement, it states calculate the sale price of children shoe division. I have calculated the sale price, present value, future cash flows. Impact on SFP. So what impact will the children of sale of children shoe division will have on SFP? As far the information is given, do you think selling children's division is having any impact on current liabilities? No, remains same. It's not having any impact on current liabilities. It's remaining same. Okay. Do you think selling children's shoes dividends is having any impact on bank loan? No, nothing mentioned. Having any impact on 7% loan notes? No. Even if you look at the question, it states that loan notes of 175 million are due to be redeemed in just over a year. This 175 million is being redeemed. And the proceeds received from selling the children's shoes division would be used to first pay off the 9% loan notes. You're paying the 9% loan notes. It's nothing mentioned that the current liabilities would be disturbed. So even if you are calculating the sale price of a children's shoe division, you've calculated, and then you're making an impact on SOFP, there is no information that children's shoe division will have, sale of children's shoe division would have any impact on. See, it's clearly written. The proceeds received from selling children's shoes division would be used to pay off 9% loan notes. You are paying 9% loan notes, okay? And part of remaining amount from sale proceeds will be held as part of current assets, so that current ratio increases to 1.4. The remaining will be invested in non-current assets. Profit should be taken directly to reserves. So how much profit you are getting, you need to see that. Non-current assets of children's shoes division can be assumed to be 608 and current assets 349. Additional investment will earn 18% pre-tax return, and additional investment in current assets 6% pre-tax return. Okay. So in no circumstances it's mentioned that if you're selling the children's shoe division, impact on SOFP, it's not having any impact on current liabilities, which should remain same, because nothing is mentioned. Sale of children's shoe division is not having any impact on current liabilities, remain same. Is it having any impact on bank loan? No, remain same. Is it having any impact on 7% loan notes? No, remain same. However, impact on SOFP of sale of children's shoe division, sale price of children's shoe division, and impact on SOFP. Due to sale, we are clearing these 9% loan notes, so this will become 0. Okay, your total non-current liabilities is going to be now 145 and 108, 253. Okay. The sale of children's shoe division, the price, present value of future cash flows, impact on SOFP. So I'm saying no impact on non-current current liabilities, same. 9% loan notes paid off, 0, 7% bank loan, and 7% loan notes and bank loan, no impact. Okay. So now, is this sale of children's shoe division having any impact on share capital? No, you are not raising any shares, so same. Okay. Is this having any impact on reserves? Yes. It mentions the profit on sale of children's shoes division should be taken directly to reserves. So how much profit you are getting? You know, the sale price is 1217 million, present value of future FCF sale price. You're getting this, but you have to lose your assets, because once you sell, the assets would be gone. So non-current assets of 608 million would be gone, and current assets of 349 million would be gone. Okay, so if someone asks you the profit from sale of this division should go directly to reserves, sale price is 1217, just calculated, and you are losing these non-current assets. So the profit is going to be 260 million. This must directly go to reserves. So impact on SOFP, the reserves will increase by 260. So 737, add 260, 997. This will make it total equity 1047. And you have the total equity, you have the non-current liabilities, you have the current liabilities. Add them all to get total equity and liabilities. $2194. This is total equity and liabilities. So obviously, if total equity and liabilities are 2194, the total asset should also be 2194. 94, right? If total equity and liabilities are 2194, the total assets should also be 2194. Okay. Now you just need current assets, non-current assets, and you will get the impact on SOFP. I would never waste my time in the exam to calculate both of them, because I will just calculate one and then remaining would be the balancing figure. Okay, so calculate any one of them and you are all set to go. The proceeds received from selling children's shoe division, how much proceeds is received? 1277 million, will be used to first pay off the 9% loan notes. You will pay the 9% loan notes, 175 million. So what is the amount left? $1042 million is left, right? Part of the remaining amount of sale proceeds will be held as part of current assets so that current ratio increases to 1.4. Now you have to keep such current assets so that current ratio increases to 1.4. You have to keep such current assets so that current ratio increases to 1.4. This is what is written. Game over. Now, what is the existing current ratio? Existing current assets are 909 and existing current liabilities are 894. So existing current ratio is 909 divided by 894, 1.01. It's saying that when you sell the children's shoe division, okay, you will keep such current assets so that current ratio is 1.4. You will keep such current assets which will keep current ratio as 1.4. So current ratio is current assets over current liabilities. You will keep such current assets so that current ratio becomes 1.4. Current liabilities, no mentioning, 894. So the current assets which we should keep is 1.4 into 894, 1252. Once you know current assets is 1252 out of this, that's it. Don't waste time in the exam on finding non-current assets. Balancing figure. So 2194 less 1252. 942. That's it. Okay. So you have calculated the sale price as well. Okay. As well as you have calculated the impact on SOFP. Okay, one last thing is required, then I will give you time to copy this. Calculate the expected sale price of children's shoe division. I've done that. Impact on SOFP, demonstrate its impact, the sale impact on SOFP, and forecast EPS. The last thing is impact on forecast EPS. Okay, if you just try to find current EPS, if you just try to find current EPS, currently both divisions are on. So the PAT is 217 million. The PAT for year one, children's shoe division is not sold. Obviously, currently you're running both 217 million. No preference shares, no preference dividend, and the number of ordinary shares seem to be no par value mentioned, so you can take 1 and 50 million. Okay, so current EPS is PAT 217 million. 0 preference dividend, and number of ordinary shares. I'm assuming par value is 1, so 50 million. Okay, you get current EPS as 217 less 0 divided by number of ordinary shares. Okay, 4.34. Okay, so sale price of children shoe division, here it is. Impact on SOFP. So everything remains same, but loan notes got cleared, reserves built up, current assets, keeping in mind the current issue 1.4, else balancing figure. Now, impact of sale of children shoe division on EPS. Current EPS is 4.34. Obviously, we are having both divisions, so current EPS is this. Okay. Now, impact on the forecast EPS. Okay. If you think about the revised EPS, so you need impact on forecast EPS, the new PAT, okay, new preference dividend, and new number of ordinary shares. So you can get the impact on forecast EPS, that if you sell the children shoe division, you have the sale price, you have the impact on SOFP and impact on forecast EPS. Okay, so what would be the impact on forecast EPS? So new EPS will be number of ordinary shares, you're not increasing, same. No preference shares issued, 0. New PAT. Okay, now obviously you have to think, if you sell the children shoe division, its PAT would be gone. Okay, its PAT would be gone. Because after tax profit of children shoe division is 76. But additional investment in non-current assets is expected to earn 18% pre-tax return, and additional investment in current assets is expected to earn a 6% pre-tax return. This is pre-tax, and this is after tax. So the new PAT working is a bit tricky here, that your existing children shoes division PAT is going, okay, but you are additionally investing in non-current assets earning 18% and 6%, that should be considered. Okay. So as far as the revised PAT is concerned, your existing PAT was 217 million. I don't have space and I don't want to change the screen. That's why I'm writing it. Existing PAT was 217 million. Okay. If children's shoe division got sold, 76 million PAT would go away. Okay. Children division sold, 76 million PAT would go away. Okay. But additional investment in non-current assets would earn 18%. Okay. Pre-tax, and additional investment in current assets, 6% pre-tax return. What is the additional investment in non-current assets? Additional investment in non-current assets. Non-current assets were 1,200. 608 million gone. 608 million gone because you sold the children's shoes division. 608 million were there. So 1,200 minus 608. It should have been 592. It should have been 592. But what are they? 942. So additional investment in non-current assets is 350 million. It will give you 18%. Okay. But for after tax, you multiply it with 1 minus T, 80%. 20% will be gone. So 350 into 0.18 into 0.8, 50 million. This will come from NCA. Okay. Additional investment in current assets will give you a 6% pre-tax return. So in current assets, you will be getting 6% on additional current assets. What are the additional current assets? Current assets were 909. You sold 349. When you sold children division, 349 gone. So 909 minus 349, it should have been 560. But how much are they? 1252. So additional is 692 in current assets. You will earn 6%, but after tax, 20% would be gone. So 692 into 0.06 into 80%, 33. Okay. Your children's shoes sold, impact on EPS, your profit from 217 million currently will go down by 76 due to sale of children's shoe, but you invested additional in non-current assets 18% and current assets 6%. Okay. So how much is the additional investment in non-current assets? Original 1200, sold 608. Should have been 592, but are 942. So you invested 350 more. And current assets 909, sold 349. Should have been 560. It was 1252, 692 more. 6% and 18% pre-tax, but after tax. So PAT will increase. And one last thing which you might have forgotten: interest saved. Remember, you paid off a loan note. So 9% interest is saved on 175 million. But again, we will get 80% benefit because when interest saved, profits will increase. We have to pay 20% tax. So 9% of 175 million, 80%. Because when interest would be saved, 9% of 175 million, interest would be saved of 15.75. Your profits would increase, but 20% tax has to be paid on that increased profit. So 12.6 million. You net them all. 217 minus 76, but plus 50, plus 33, plus 12.6. It is going to be 236.6 million. Your new PAT is going to be 236.6 million. Okay. And now you can easily get new EPS. That is PAT 236.6 less preference dividend 0 on number of ordinary shares 50, 4.7. Okay. Considering the P4 standards, I'm not finding this paper a very tricky paper, trust me. The ZG company one, obviously a time-taking question, but not that difficulties which we traditionally see in P4, AFM. There's Hanwood shoes, sale price, FCF, very easy. Impact on SOFP, very easy. EPS had some technicalities which we managed to cater. Okay, so we are done with the part A of the question. So please copy it so that we can continue with part B and part C. Yes, there are more parts to this question as well. Part B and part C. Both theoretical requirements of 12 marks. So once you copy, we will be moving towards that. Okay, now second part B is discuss whether Hanwood Shoes investors are likely to be satisfied with the proposed sale of Children's Shoes division and its consequences for profit and fund. There are two requirements. Discuss whether Hanwood Shoes investors are likely to be satisfied with proposed sales of Children's Shoes division, one requirement, and its consequences for profit and fund. Okay. So firstly, whether Hanwood Shoes investors are likely to be satisfied with the proposed sale of Children's Shoes division. You can write your opinion, but in my opinion, if it is asking that whether investors are likely to be satisfied with the proposed sales of Children's Shoes division, my opinion is investors won't be satisfied with proposed sale. Now, if I have written they will be satisfied, I need to justify it. If I have written investors won't be satisfied with proposed sales, I have to justify it 3 or 4 points to gain 3 or 4 marks. Don't think the bullet points I'm writing are going to secure you 1 mark. You have to elaborate them further. I am here just to give you ideas. Why investors won't be satisfied? Okay. Because this proposed sale, it's just based on an assumption that children shoe market will become competitive. It's just based on an assumption that children's shoe market will become competitive. Investors will be concerned and they will be dissatisfied with this proposal. They will say, okay, if a market is being competitive, we will face the competition. What is this that you are running away by selling because the market is becoming competitive? And this is just what the board feels. This has not happened. So something which is just felt not happened, how can you take such a big selling decision on that? So once you write these two or three lines, you get the 1 mark for the point. That investors won't be satisfied with the proposal. They will say, okay, it's just based on an assumption that market will be more competitive. Why are you running away from competition? We have been in this business for many years. You will face competition. Why there is a need? And secondly, you're just thinking it will become competitive. Let it happen, then take decision. Okay, 1 valid point, 1 mark. Investors won't be satisfied because second point, business will become less diversified. At the moment, business is generating money from 2 areas, adults and children. Selling one business means you will be dependent only on adult shoes, so diversification will be less, so risk level will be high. This might also prompt investors not to be too much satisfied. Okay. Thirdly, children shoe market has always been a cash generator. Remember, it was written, children's shoe market is a cash generator. So you are leaving that cash generator, okay, and going towards adult shoes. So losing a cash generator may mean that if in further you need any funds, the cash generator won't be there to generate funds. Okay. They won't be satisfied because they might wonder, to pay off debt, there can be other options than sale, like raising more equity. It reduces gearing, generates cash, you can pay off debt. Okay. Or you can sell your assets, some assets, rather than selling business, sell the assets, generate cash to pay off the loans. And if you're selling assets, how will you do production? Outsource the children's shoes production also, like you did with adult shoes. There is no need to sell a complete business. Okay, so see, whatever I've told, if you write this stuff, it would be a good matter of 4 or 5 marks. So whether Hanwood Shoes investors are likely to be satisfied with the proposed sales of children's shoes division. It won't be satisfied, 4 marks. Okay. Its consequences on profits and funding. Okay. Let's see the consequences on profits. So you have already mentioned that consequences on profits are increasing. Okay. And since profits are increasing, the earning per share is also increasing. So impact of decision on profit seems good. Impact of decision on profit seems good, because due to this decision, the profits is increasing. And due to this decision, the EPS is also increasing. Okay. So overall, you can say that impact on profit seem good. Okay. What will be the impact on funding? Because it is asking, discuss whether Hanwood Shoes investors are likely to be satisfied with proposed sales. So I've told that not satisfied. Its consequences for profits and funding. Consequences for profits seem good, because you are generating improved profits, higher EPS. That's a good consequence on profit. Consequence on funding will also be good, because selling a huge division, maybe it is bad for investors, but from funding perspective, it's good. You are getting 1217 million funding. You can not only pay your 175 million loan notes, you can pay other debt as well. You can invest in additional non-current assets as well. So consequence with respect to profit and funding is good, but it has a huge cost that the business risk is increasing, because selling one division means you are completely dependent on one area, which increases risk. So I think if you just write that profits consequence is good, considering it's increasing, and EPS is also increasing, funding impact seem good, 1 mark for these, and then 4 or 5 marks for that, whether investors are satisfied or not, you get 7 marks. Okay. Discuss the implications for future profits and liquidity of the alternative suggestion made by the NED. Now let's see what suggestion NED has. Here, and NED has asked why liquidity needs to be improved. He claimed that higher profits could be achieved by investing funds not required to repay the loan notes in non-current assets. He thought that Hanwood Shoes could maintain the same level of current assets as it is now. So maintain same level of current assets, invest in non-current assets, so that higher profits can be achieved. No need to do liquidity. Discuss the implications for future profits and liquidity of the alternative suggestions made by the NED. Now, as far as NED's suggestion is concerned, NED's suggestion have a very bad implication on liquidity, implications on profits as well as liquidity of the suggestion made by non-executive director. The non-executive director's suggestion on liquidity seems to be very bad implication for liquidity, because he's asking why liquidity is needed. He's asking why liquidity is needed. In simple terms, liquidity is needed because we are having difficulties in paying our suppliers. So if we don't pay suppliers on time, they won't give us the goods, and how we will sell. So if he's saying that why there is need for liquidity, and he's saying, okay, no need to do liquidity, just invest in non-current assets to gain profit. So these suggestions have very bad impact for liquidity, because if there is no liquidity, you don't have money to pay suppliers on time, they won't give you goods. And once they don't give you goods, you won't be able to sell anything. Bad for the company. Okay. However, his suggestion may have a good implication for profitability. Okay. Because his suggestion is that you should invest in non-current assets, and non-current assets investment is giving 18% return. So shareholders will be satisfied with 18% return. So his suggestions, non-executive director suggestions, to gain the marks, you should first write what are his suggestions. And after you write his suggestions from the question, you can say that they have good implications for profitability, because he's asking non-current assets to be invested, get 18% return. But his suggestions have a very bad impact for liquidity, because he doesn't consider liquidity good or important. So you don't have money to pay suppliers, and you don't have goods. One supplier has already threatened to delay. So this will have bad impacts for liquidity. Okay, this is a complete 25-mark question. Do read the examiner answer to gain more knowledge. Also, you can never write the same answers as examiner, not so much length, but if you have general knowledge and you write it, you will surely gain good marks. Okay, thank you very much.